Well, hi folks. Let's talk about natural gas again today. It's a very cold and windy and blustery day here in Port Elizabeth, South Africa. So I'm wrapped up a little bit warmly and it's pouring with rain, which is good news because we need the rain. Our dams have been very, very low, critically low, and this will help to fill up the dams a wee bit. I've got the natural gas chart on here. This is the 4-hour chart of my contract, August contract at Black Bull Brokers. You can see what it looks like. I put a few lines on here and things, moving averages, and we'll have a look at that in a minute. But first of all, I want to talk about Contango and backwardation, and there seems to be a little bit of confusion about what these are. I've taken these notes from the cmegroup.com. They've got quite a good explanation on here, just to let you know. And I'm going to tell you the reason why we're looking at these in a minute. So let's just spend a minute just reading through this. What is Contango and backwardation? Contango and backwardation are terms used to define the structure of the forward curve. When a market's in contango, the forward price of a futures contract is higher than the spot price. So this would refer to the spot price, the current spot price, for those of you who are trading spot prices, or something like contract for difference, compared to the August futures contract price, September, October, November, and going forward into the months and years that lie ahead. When a market is in contango, the forward price of a futures contract is higher than the spot price. If you compare the September, October, November, etc. forward contract prices, which are currently trading and are available to trade, you can compare those to the current spot price or the current month's contract, the August contract, and see whether they're higher or lower. And contango is when the forward price of a futures contract is higher than the spot price. Conversely, when a market's in backwardation, the forward price of the futures contract is lower than the spot price. This chart above here is an example of a backwardated forward curve, and as time goes on you can see the price begins to drop. Let's have a look at a contango chart. In the chart below, the spot price is lower than the futures price, which has generated an upward sloping forward curve. This market is in contango. The futures contracts are trading at a premium to the spot price. In other words, the further forward you look into the future, the higher the price gets for those contracts. Physically delivered futures contracts may be in contango because of the fundamental factors like storage, financial costs, cost to carry, and insurance costs. Or what's not mentioned in this paragraph is that the current demand is higher than future demand is foreseen to be. The futures prices can change over time as market participants change their views of the future expected spot price, so the forward curve changes may move from contango to backwardation. This is an example of a contango forward curve. This is what we often see on natural gas. You can see the spot price, or the current futures contract price, is lower than those contracts moving ahead into the future. Backwardation, on the other hand, is kind of the inverse of that. In the chart below, the spot price is higher than the futures price and has generated a downward sloping forward or inverted curve, which is in backwardation. The futures forward curve may become backwardated in physically delivered contracts because there may be a benefit to owning the physical material, such as keeping a production process running. This is known as the convenience yield, which is an implied return on warehouse inventory. The convenience yield is inversely related to inventory levels. When warehouse stocks are high, the convenience yield is low, and when stocks are low, the yield is high. You'll see this sort of curve on futures contracts for Brent crude oil, for example, or WTI, where the current spot price or the immediate futures price is higher than the futures prices going forward into the future. And then finally, convergence. Over time, as the futures contract approaches maturity, the futures price will converge with the spot price, otherwise an arbitrage opportunity would exist. Having said all of that, the natural gas prices are currently in contango, and very often they are. What that means is the current futures price, the immediate futures price, or the spot price is lower than the futures prices going forward. Now, these forward futures contracts may change as we get closer and closer to them, as rollover or maturation approaches, and as traders begin to bid them up or sell them down, depending on projections for the future. So when you look at these charts, that's as it stands at the moment. It's sort of a snapshot of the way the market is currently perceived at that moment in time, and this curve can change from day to day and week to week and month to month as time progresses. So with all of that in mind, let's have a look at natural gas. And on this table here, which I've got from barchart.com, you can see the cash price and then the futures contract prices going forward, going through August 23, September 23, October, November, December, and then into 2024, January, February, March, etc. going forward. This first column here is the last quoted price, the move up and down on the last time this was quoted, which was on Friday, and then the various open price, high price, low price, close price, etc., with the close price being this one down here on the left-hand side. So let's go through this very quickly. So the spot price currently is at 258. I'm going to round it off to 2 decimal places. Then we've got August, the one I'm trading right now on Black Bull, also at 258. So the spot price and the August futures, normally they're pretty much identical. And then moving forward into September, now this is the interesting part. Let's have a look, and I'm just going to read them out as we go from month to month through towards the end of this year. So in September, we've got 257, October 266, 307 in November, 351 December, 375 in January, 368 in February. So going up pretty sharply towards the end of the year into that $3.50 level. In fact, between $3.40, 50, 60, and 75, the highest there is 75. And then going forward into February, as the winter begins to subside, you can see prices beginning to come down. Then we've got 368, 341, 312, 311, 321, 333. Going through to summer next year, we hold above $3. Now this is interesting. So the current price at 258, the spot price, and the August contract remains the same in September, October ever so slightly higher, and only in November do we get up to that $3 level, and then in December and January and February up to the 350 to 375 level. This is what I spoke about in my previous video, saying that we may not get above $3 until we get into somewhere around November or December towards the end of the year, when the biggest stock drawdowns occur. We move into winter, and there's a much higher demand for natural gas for heating. What's interesting about this table, and I don't have the actual chart or the curve, the forward curve for this. Obviously, if you put this onto a chart and you plot it out, like we saw here in this example on the CME website, you could take the numbers on that table and put them into a chart format that looks like this. But you can picture it. If you just use a little bit of imagination, you can picture how that chart might look. So we've got 258 this month. We've got 258 next month, 257. So no change between the August and September contracts, and very little change even into October, still well below $3, and in fact below 270. We're at 266 in October. And then only in November do we hit that $3 level, slightly higher. Then December, 350, January, 375, February, 368. And beyond that, prices stay significantly above $3 going into 2024 and throughout 2024 right to the end. We can look way ahead as it stands at the moment. Remember that these prices will change because these contracts are being actively traded all the time. But if you go into the end of 2024, we start to get into the $4 and above levels for the price of natural gas. So with the caveat that these numbers will change and do change all the time as traders are trading these contracts in and out, and all sorts of things can affect these prices over this period, and we're talking into the end of next year. Having said that, the way that stands at the moment, the way the market is being viewed by traders, we're not going to see anything above $3 until we get to the end of the year, and we're not going to see much change at all overall until we get to November this year. So we've got 3 months where the futures prices are trading more or less at around $2.60. So August contract, the current contract, we're trading 358. Then we've got September contract 357, more or less the same. Then we got the October contract at 266. And only when we get to the November contract do we see the price moving above $3. This tells us that we might actually be stuck somewhere either side of the $2.60 level until we get to the end of October. So with that little bit of information in mind, and bearing in mind that these numbers can change, and there can be reasons for that, such as weather, excessive drawdowns, war, pipeline disruptions, geopolitics changing, breakdowns, changes in the number of oil rigs, variations in the supply lines, swapping and swapping between countries, government regulations, all sorts of things can change these numbers. Remember, each one of these contracts is currently being actively traded well ahead into the future. And like any traded contract, the prices can and sometimes do change dramatically. So keeping all of that in mind and looking at these futures numbers suggesting that we could stay stuck around the $2.60 level for the next month or 2 or 3, let's have a look at the chart. So here's the 4-hour chart, and really what we've been saying is that we consider this trend to be bullish, that we need to move up to about $3. The futures prices would seem to agree with that, and eventually up to the $3.40, 50, 60, or 75 levels towards the end of the year. And the way the futures contracts are currently being traded, they seem to concur with that view. We also saw from those futures contracts and the fact that we're in Contango with the current contract prices being lower than future futures contract prices, means we could actually see some slopping around about this $2.50 to $2.60 level for the next several months. Now, I'd give it one standard deviation either side of that, at least, perhaps two standard deviations, and we can put a Bollinger Band on there to actually measure that. So what we're allowing is for a normal distribution. Markets are not arranged in normal distributions, but it's the best that we can do for the moment. And if I put a normal distribution around about the current price, we can have a look at where the extremes of those ranges might be. So I've drawn on here a Bollinger Band. Now, a Bollinger Band is kind of just a representation of a normal distribution either side of the price, normally representing two standard deviations above and below the price. I like to use the 200 period Bollinger Band. So I'm going to change these settings from 20 to 200, and I'm going to get rid of the central line as well. We'll have a look at the 200 period and the 100 period as well, just to get a sort of broader perspective of things. And I've got it set at 2 standard deviations. Without going into the mathematics and the statistics of standard deviations, Gaussian distributions, it probably suffices to say that most of the time the price will range between the upper and the lower Bollinger Band, with occasional excursions outside that level. So let's see where we look on the 200 period Bollinger Band. So you can see the upper Bollinger Band is at about 287, and that actually coincides with that high that we saw recently. And the lower boundary of this Bollinger Band, or the lower Bollinger Band, is at just above $2, at about $2.10. Now, this Bollinger Band will continue to move upwards as long as the price trends upwards, and the whole Bollinger Band will begin to move downwards if the price moves downwards. But you can see roughly that this kind of outlines our idea. A top part of about $2.87 and a lower part at the extreme, remember these are extreme levels, at around $2.10. Let's change this to 100 periods just to get a different perspective, a shorter time frame. And there's the 100 period Bollinger Band, and they're both worth looking at. So again, the upper Bollinger Band, the top Bollinger Band, is at around 286, but in this case the lower Bollinger Band is at around $2.50, $2.47, 45, somewhere around there, which is also where the 200 period moving average is on this 4-hour chart. So looking at the 100 period Bollinger Band, the immediate support level is at around $2.45 or 50, which is also where the 200 period moving average is, and it's also where some of these Fibonacci levels are, the 38%, which is more or less where we are at the moment, and then the 50% Fibonacci just below that. So we've got this beautiful range between $2.53, just about where the price is currently reached, which is the 50% Fibonacci, the bottom of this pink range, and still above this lower rising channel line. My idea is that we'll probably drop down a wee bit, and it depends again on the open tonight, a little bit later on in a few hours' time. That's going to be very telling to see whether we gap up, gap down, or remain at more or less the current price. But I wouldn't be surprised actually if we gap down a wee bit, down to about $2.40 to $2.45 to this 50% retracement level. 50% is always a very healthy retracement in a good trend. So we'll have dropped down there. And it's also where the 200 period moving average is, more or less, and this lower 100 period Bollinger Band. Bear in mind that we've got the channel line beneath us, which is a little bit lower at about $2.35. And we've also got this very key support, crucial support level at $2.15. To summarize all of this, I think we're going to bounce somewhere between $2.50, which is roughly where we are at the moment, and $2.35, which is where this channel line is, and where we will have tagged the 200 period moving average and the 100 period Bollinger Band. Now, I don't want to complicate this with too many lines. You know, I don't like lines all over my chart, and I don't like indicators and Bollinger Bands and things like that all over the show. So once I put them on, I take them off very quickly. So I'm going to remove this Bollinger Band, and I'm going to leave some of these things on for brief discussion, and then I'm going to remove those too. So let's go to this yellow highlighted text. That level there is the breakout from this downtrend. You can see we've got a downward trend line, a breakout. And that breakout took place at roughly $2.33, 34, 35. Now, often after a breakout, the price will return to that breakout level before resuming the trend in the direction of the breakout. So the breakout was from a downtrend, it broke out upwards, we started forming an uptrend, and there's a possibility we'll come down to that breakout level, bounce off there before resuming higher. And coincidentally, that's actually at this channel line at about $2.35. So I'm allowing for that to be the kind of most important level for us to reach before bouncing and moving higher. So that's the trend breakout level. Now I can take these off my chart to clean it all up a bit. The other thing that I've got drawn in here is this rising trend line. Now, I don't think this is a particularly significant trend line, but it is there, and it's one of the reasons why I'm in the current trading position that I'm in, which I'll describe to you in 2 minutes' time. So here I've cut off the wicks of these candles, and often when I draw trend lines, I cut off the wicks. The wicks are often just spikes, which indicate that there was a very brief visitation to that area. There was a lot of demand, in this case buying demand, which pushed the price back up towards its actual trading ranges. For the wicks represent a very brief moment in time. The real action, and the Japanese candlestick enthusiasts will agree with me, the real action is depicted by the real bodies of the candles. So when you draw a trend line, sometimes, and I often do it with stocks as well, not so much with currencies, but stocks and commodities, often when I draw trend lines, I cut off the wicks and focus on the real bodies of the candles. So if you draw this trend line up through here, through these real bodies, you can see we've bounced back onto that trend line now at $2.55, and we've actually bounced off it with a real body. So that trend line has not only cut off the wicks down here, but it's also kind of cut off the very tiny wicks at the current price. This is a very bearish 4-hour candle pattern. We've got 2 wick highs up here against the 20-period moving average into that resistance zone. This is a double top almost as well. If you looked at it on an 8-hour chart, it might be a tweezer top. So overall, this is a pretty bearish pattern with downward momentum being quite significant. I expect that we'll probably break through this green trend line. It is there, but I'm going to remove that too. And that leaves us with a much simpler chart with this arrow pointing down to the channel bottom, the breakout point from this previous downtrend, and somewhere near and into the 100-period Bollinger Band. We don't mind spiking through the Bollinger Band a little bit. Often the price does that. As you will have seen when I had the Bollinger Bands, you could just rewind the video a little bit if you want to and have a look at the top area there where the price actually spiked through the Bollinger Bands. So we could allow for a spike down through that 200-period moving average, that lower 100-period Bollinger Band, and down to perhaps this rising channel line before a bounce up and a resumption. Remember the reasons I put the Bollinger Bands on, the 200-period Bollinger Bands and the 100-period Bollinger Bands, is because the futures prices seem to indicate that we will be stuck in and about the $2.60 range for perhaps a month or two. Now I know that's not good news for the bulls in natural gas and for those who are thinking that this is going to blast to the moon and that we're going to bust up through $3 anytime soon, and then we're going to rush up into $3.40, $50, $60, $75. The futures contracts don't seem to indicate that. Remember, those contracts are being traded every day, and those sentiments can change depending on a whole plethora of different reasons, which I mentioned earlier, which may change sentiment towards those futures contracts reaching out ahead into the end of this year and into next year. So we can't rely upon those prices as set in concrete, cast in stone, because they're not. They change every day. But the way it stands at the moment, there's not a lot of price movement between now and somewhere around about November this year, when we start to move into the colder winter seasons and more gas starts getting used and the inventories start reducing and coming down. Looking at it from a purely technical point of view, it looks to me like we've got some bearish momentum that we may gap down into the open, perhaps down to $2.48 with this 200-period moving averages on the 4-hour chart, and then maybe down to this channel bottom over the next day or so, down to about 235, perhaps 240, which is the 50% Fibonacci, and then a move back up. And then first thing we have to do is retest this very small, perhaps insignificant downward trend line. I've got it drawn in there for now, but I'm actually more interested in the horizontal levels, and that level there going back to sort of mid-May, or 3/4 of the way through May, at around about 267 is the obvious resistance point. That's the point that we couldn't get through on the last couple of attempts on the 4-hour chart. It's also where the 20-period and the 50-period moving average currently are. Okay, so all of that was a bit of a handful and a bit of a mouthful. Let me tell you and remind you about my current positions. So I'm long from $2.62, a 50% position, meaning 50% of my desired total position size. I'm long from $2.62. And on Friday, I hedged that position with an equal size position short at $2.57. So let's call it one position long at $2.62 and an equally sized position short at $2.57. Both of those positions are equal in size and they're equal to 50% of my desired total position on natural gas, which is in the long direction. I'm trying to trade long only currently because we're coming down into what I consider to be a bullish market. The reason I've hedged is because we could get a little bit lower than we currently are, and because we broke through support on Friday, after we encountered some slight surprises in the storage numbers and the Baker Hughes rig count. So I'm allowing for a dip back down into some of these lower levels beneath us. At some stage, I'm going to take profit on the short side of my hedge position and then add to the long side of the hedge position for a move higher. And I'm going to be watching the 4-hour charts, the 4-hour price action, 4-hour candles, and any particular news and information that may come out of the market, particularly anything affecting the US dollar dramatically, which will affect the price of gas and oil and all sorts of other commodities too. If we have a look at the Henry Hub prices on the NYMEX chart, we can see a similar sort of thing. What's interesting about this is we've fallen down through the support level, which shows roughly the same levels depicted on my other chart, on my futures chart at Black Bull, at $2.60. We did form a bit of a spike low. Now this doesn't mean that we're going to move higher or lower. It's kind of an indecisive, this is a daily chart, it's kind of an indecisive candle. But what's interesting is that we did have this wick low or spike low on this day chart. So we dropped down to $2.54 or 55 and bounced back pretty sharply from there. It's not an altogether bearish daily candle, not by any means, but it's also not bullish. So it's a kind of hesitation candle. What we do see is a lower high and a lower low. So overall, and we've seen that for the last 3 days now, we had an inside day on Monday. So that was a hesitation day, which could have gone either way. We tried to break up actually after that day and then fell back down. So those 3 days in a row are forming a bearish sequence of lower highs and lower lows. But we did have a little spike. There's the 20-day moving average. So we did not close beneath the 20-day moving average, which is always a little bit suspicious for me. If we don't close beneath the 20-day moving average, in essence, we remain on the bullish side of the market. So it's a little bit scrambled on the day chart, and we don't really know what's going to happen. We do know where support is beneath us, this yellow zone, where the 50-day moving average is. We do have lower highs and lower lows. We've got 3-4 black candles in a row so far, so there's no reason to expect this is going to reverse immediately. But there's also a little bit of doubt as to whether this downtrend has any steadfastness or resolve to moving further. That we don't know yet. So I think we have to rely on the 4-hour charts to kind of get a feel for it. Here's the 4-hour charts. Remember, those Henry Hub charts are a little bit delayed, so they haven't actually picked up the last 15 minutes of trade, which did see a little bit of a move down on the 4-hour chart in the August contract. So we closed a little bit lower than is suggested by the Henry Hub chart on the NYMEX. So let's see how this opens. I have a small suspicion that we may open a little bit lower tonight in a couple of hours' time, perhaps a gap down to the 200 period moving average on the 4-hour chart, which would take us down to about $2.48 to $2.49. And that break below or gap below this red line support here might be sufficient to take us down to the bottom of this next swing low. That's a crucial level at $2.44. That's the last major swing low. Keep that in mind. Put that price in the back of your mind, $2.44. I think we might test that and then decide what's going to happen next. And if we fail to hold above that swing low, then we're going to have to get down to the bottom of this channel line, down to 10 cents below that at 234. I've got to time this very carefully because I want to take my short hedge off at the right time, take some profit on it if I get the chance, and not expose myself too early to the naked long side of the hedge once I remove the short side from there. But I do want to maximize my profit on the short side of the hedge with any move further down from here. So I'll be watching this level at 244 very, very closely. I'm looking for reversal candles on the 4-hour chart, spike lows, wick lows, engulfing candles, in other words, bullish engulfing candles, piercing patterns, double bottoms, inverse hammer candles. Anything in the basket of the candlestick trading tools is what we're looking for to indicate a bottom against one of these key levels. We know where those levels are. 250, this top red line, 245 or 244, this last swing low, or perhaps down to this 240 level, which is the next Fibonacci level, or down to this channel bottom and this previous trend breakout level at around about 230 to 235. We're going to have to be a little bit nimble and a little bit attentive to the charts after they open up a little bit later on today. Make sure that we don't get out too early from the short side. If we don't gap down on the open and just stay where we are, we'll have to see how that progresses. And if we gap up, we might have to fill the upward gap. In other words, come back down into the gap, see whether we fill it and then bounce back up again, or continue on further lower. So it's going to be all action come the market open. We know where the levels are. I've got a basically risk-free position on, 5 cents difference between my buy and my sell part of the hedge. So there's no worries there. There's no urgency to act quickly, but we need to act at the right time. And I think that's it really. So you've seen my strategy, you've seen the levels. We're going to wait to see how the market opens. Good luck for trading natural gas this week. If you've enjoyed this content, please give it a thumbs up. And if you're new to the channel, why not subscribe? And if you're not new to the channel, but you haven't subscribed yet, why not subscribe? Take care and good luck with your natural gas trading this week, and I'll speak to you as the week progresses.